If you're watching this video, you probably spent the last week looking at your portfolio and feeling a pit in your stomach. The rupee is at 94.12 and the geopolitical floor has just dropped. And everywhere you turn, the advice is the same. Buy the dip, stay the course, and don't panic. But let's be honest with each other. If you are buying the dip without a structural plan, you are not an investor. You are the exit liquidity that institutional players are using to flee a burning building. And I have covered this many times in this year. So please be aware. Most Indian investors are trying to play a 2015 game in 2026 reality. In 2015, the rupee was stable, global markets were predictable, and buying and holding an index was enough. Today, that playbook will leave you broke. So today, we stop the hope-based investing. We are going to deploy the Waterfall Protocol, a 60-month financial engineering blueprint designed to build a 50 lakh profit engine no matter how many red days the Nifty sees. This is the finale of our goal-based investment series. By the end of this video, you won't just have a strategy, you will have a deployment schedule. So let's build your fortress together. Before we talk about making a single rupee in profit, we have to talk about why you have probably failed in the past. It was not because you picked the wrong stocks, it's because your portfolio was fragile. So think back to the last time you had to sell an investment. Maybe it was a medical bill, a sudden car repair, or an EMI that hit harder than expected. You were forced to sell your mutual funds while the market was down 15%. So you did not just lose the money, you actually broke the chain of compounding. And that is the cardinal sin of wealth. To prevent this, our first 12 months are dedicated to creating a shield. This is your portfolio's uninterrupted power supply. Do one thing, please open your bank app right now. Look at your total monthly burn, rent, groceries, insurance, school fees, etc., and multiply that number by 6. If you spend 2 lakhs a month, your shield target is exactly 12 lakhs. Now I know what you are thinking, but what if the market rallies while I am building this shield? I'm missing out on the bull run. Listen to me, it does not matter. Until this 12 lakhs tank is full, you are not an investor, you are a risk. You are one bad month away from liquidating your future. So we are making you unbreakable. So please follow it. Where do you put this money? Most people default to savings account or an FD. That is a mistake. In 2026, a 7.5% FD in the 30% tax bracket is a capital trap. After tax, you are left with 4.9%. With inflation just about 6%, the bank is literally charging you for the privilege of losing your purchasing power at the rate of minus 2% per year. So instead, we use arbitrage funds. These funds exploit the price difference between the cash and future markets. And they don't care if the Nifty crashes 2,000 points or 20,000 points. They stay flat or marginally green. Because they are taxed as equity, your 2026 LTCG is only 12.5%. That is an immediate 2% net gain just by being smarter about the tax code over the course of next 5 years or 60 months. At the rate of 1 lakh rupees per month, 100% of your surplus goes here. No multi-baggers, no crypto, just filling the shield up to 12 lakh rupees. So welcome to month 13. If you have followed the protocol, you now have a superpower. You can watch the news, see the rupee at 94, see the market crash and go to sleep peacefully because your shield is now fully pressurized. So now we open the valve. From this month onwards, 13th month onwards, 60% of your monthly investment limit flows into something called the core. The shield was your uninterrupted power supply. The core is your forever engine. It's the money that will fund your retirement or your children's Ivy League degrees, or in simple terms, your 50 lakh profits in the next 60 months. But in 2026, we have to acknowledge a hard truth, the home bias trap. Most Indians earn in rupees, save in rupees, and invest 100% in Indian stocks. You are betting your entire life on a single geography and a single currency. But when the rupee devalues from 83 to 94, your local gains are being decimated by a global tax. If your Nifty portfolio grew by 12%, but if your currency fell by 5%, your real world wealth only grew by 7%. So I'm sure you've done that math, and if you've not done it, do it right away. So to plug this leak, we will implement the 50-50 core split logic. Start with 50% investment in Nifty Next 50 index funds. So why not the Nifty 50? Because the Nifty 50 is full of zombies. They move the index, but they don't move the needle for your 50 lakh goal. So Nifty Next 50 contains the aspirants, the company fighting to enter the top tier. They have the stability of large caps, but the hunger of a mid cap. So it's a self-cleaning machine. When a company wins, it graduates to the big league, which is Nifty 50. If it fails, it's kicked out. So you are owning the high velocity engine of India's future. So start your 50% investments in Nifty Next 50 index funds. And now let's see where the next 50% goes. 50% of your total investment goes in S&P Global index funds. This is the most critical bridge we are building. By owning the S&P 500, you are not just buying Apple or Nvidia, you are buying the US dollar. When the rupee drops to 96 or 98, which is what the math suggests that it might, your holding in the US market grow in value automatically in rupee terms, even if the stocks stay flat. So this is the currency carry. For the first time, a falling rupee is a tailwind for your wealth and not a headwind. And now let's get to the exciting and the final part of your investment, the alpha, also called as the Usain Bolt of your investment model. So remember, the shield was your uninterrupted power supply, the core was the engine, and alpha is the Usain Bolt of your investments. So the remaining 30% of your monthly surplus flows into the alpha tank. And this is where people usually get in trouble. If they hear a tip or a WhatsApp and see a multi-bagger on Twitter, they gamble. So we will not do that. In the alpha tank, we are not investors, we are trend riders. We look for the government Capex Trail. In 2026, the state is pouring billions into 3 specific sectors: defense, green hydrogen, and semiconductors. So these are not speculative bets, these are industries with a full order book guaranteed by the government for the next decade. But we don't marry these stocks, very important. We use one cold mechanical rule, the 200-day moving average. If the sector is trading above the 200-day line, we stay in. The moment it breaks below, we exit. No hoping, no waiting for a bounce, we leave the building. To hit that 50 lakh profit target, this is the most important discipline. Every time an alpha play hits a 20% or 30% profit, we don't let it ride. We flush that profit back into the shield and think about the psychology of that. Most people make a profit, get greedy, and lose all of it in the next risky bet. But we do the opposite. We use the market's greed to make your foundation thicker. Your risk money is constantly being converted into a forever wealth. So by year 5, your shield is not just 6 months of expenses anymore. It's a massive fortress built entirely with market's money. Let's look at the final dashboard. Year 1, you built the shield and you became unbreakable. Year 2 to 5, 60% in the core global domestic picks and 30% in alpha, capex momentum, and a 10% buffer. With a 1 lakh monthly investment and a 10% annual step up, you cross 1.23 crores by the month 60. So this is a 50 lakh of pure engineered profit. This profit did not come to you because you were lucky or you did not win the FNO casino. You won because you respected the velocity of money and neutralized the tax laws. You hedged against the falling rupee and you followed the sequence. Like I said at the beginning of this video, the 2015 playbook is dead and 2026 waterfall is here. And this brings me to the end of the video. I hope you have made your notes and you are going to evaluate your portfolio as honestly as you can. And if you are going to follow my plan, please let me know in the comments. The 2026 goal tracker and the full 60-month checklist are in the pinned comments below. So stop saving and start engineering. Thank you for tuning in. Thank you for your time. Stay sharp, stay global, and thanks for watching.